All right, and we were recording. So welcome to this. So this is what we call our Banking 202 series with Practical Wealth in association with Alpha Omega Wealth with my special guest, Yvonne Burke, um, and all the way from Vegas. And so what we're going to talk about today, so what we've been doing, probably what the last 3 or 4 months, we're going to do it every month, is, so this is, if you knew, this is for our clients as you're listening to this. So if you see this recording or if you jump on and you're like, infinite banking, what's that? I won't say you're in the wrong place, but just let me know so I can, kind of send you some information to kind of catch you up to speed. But we're going to go over a little bit of the beginning. But basically what you want to do is banking is a process and you've got to learn how to use this system. So this is for our clients to really, learn how to, because it's really, I always tell people, like, in my mind, this is really, they see people say it's become your own banker. And I really say, I think about it in terms of being your own money manager, because it's really about managing of money, cash flow management. And one of the things I'm reading from the book, the intro of the book, one of the things Nelson said, this book demonstrates that your need for finance during your lifetime is much greater than your need for protection. So the whole idea of this strategy is to recapture the interest one is paying to banks and finance companies for major items that you'll need during your lifetime, such as automobiles, major appliances, education, homes, investment opportunities, business equipment, etc. This process is not about investing, right? It's about the fact how you finance everything that you buy. So with that, what we're going to do is I always like to review, because you can't see this stuff too much. This is the lawyer speak. This is, who's this handsome devil? How you doing? So anyway, what, what, so let's talk about how banks make money. This is my favorite thing, because what you want to do is see, folks, they have all the money. So I look at it and go, well, let's figure out what is their business model. I want to copy that because success leads clues. They seem to have all the money. So in the banking business, there are three parts, three players in the play. There's the saver, there's the banker, and then there's the borrower. And so when you look at this, Bank of America has over $1 billion of deposits. So y'all putting money in the bank, direct deposit, they got $1 billion of deposits. They paid out $9.3 billion in interest. And to the borrower, to the lender, because really when you put money in the bank, you're unsecured credit, you're loaning it to them, right? And then they're loaning it out to people that need cars and credit cards and student loans and what have you, houses. And they made $59.7 billion. Okay. That's so their average, they paid out 0.88% interest and they earned 5.8% interest. So that spread is their profit, right? And that is a 660% spread. So how many businesses have a 606% profit margin? Okay, just on GP. And so how can you, so think about this, if you're an investor or if you're in business, if you could add this business model to whatever you're doing, it stands to right that everything you're doing will get better, right? And so, Yvonne, you want to take over this part? Or you want me to go over this part? You're mute. Unmute.
I'll take over this part.
Okay.
Let me just share my screen. That way I can go into the next one. You can finish talking, but I'll just put up my side.
Talk about what? I don't have nothing to say if I don't have a slide. No.
So yeah, I need you to unshare your screen, like, to
Oh, yeah.
up, and I'll put mine on. And then I'll do my thing here. I'll start it exactly on the same slide. Hold on. Can you guys see my screen?
Not yet.
Okay. Here
Come
we go.
on now. All right, so now we see your computer.
I'm here. Okay. So hopefully we'll be in the same, hold on. There we go. Okay. I'm sorry, finish your thoughts there, Curtis, you were talking about.
Keep going, because I forgot.
Oh, are you done? Okay.
Yeah,
This is
done.
very informal, obviously. So the discussion today really is going to be understanding of who the players of your banking systems are. And it's important for you to not only know why and who the players are, but also it's important for you to understand how the actual policy works so that you prepare for the next policy or the next banking system that you have to take. And when we talk about that, we're going to talk about something that is called a modified endowment contract. And you might have heard, either if you talk to me or you talk to Curtis or even Vicky or any of our associates on the call, the fact that there is a limit, there is a line, right, that the IRS has imposed in these life insurance policies, that if you go above that line in funding, it becomes a taxable event. So when we build, and I want to read really quick what a modified endowment contract is, which is the tax qualification of a life insurance policy whose cumulative premiums exceed federal tax law limits. So that tax law limit is based on the amount of insurance that you're putting on a person versus how much they're adding to the PUA rider component of the banking system. And when we build our banking models, we always build them in right up to this MEC line. We always try to show you what is the maximum that you're allowed to put in. Now, is that mandatory? No, right? You fund your PUA rider with whichever way you can fund it. However, it's important for you to know what is my MEC line? What is the maximum amount that I'm allowed to put in here? Because I feel like, and Curtis and I were talking about this earlier, I kind of feel like sometimes people think that they can just continue to deposit, right? Like this is like a regular bank. Oh, you know, I have extra. If you have maxed your PUA rider for the year and you add $1 more to that component, it will cross this line and it could become a modified endowment contract. And what we're going to talk about today is how do, once I get into this MEC line level, once I know that I'm funding, and now I have excess cash flow, excess money that I can deposit, right? What do I do then? If I can't put it in this banking system, where does it go? So we're going to talk about layering of policies and understanding who the players of these policies is so that you can start thinking about what my future banking systems will look like, okay? So we're going to start with who is the insured? Okay, that's the first player in a life insurance policy. And the insured is the person whose life we're using in order to underwrite for the death benefit of the policy of your banking system. And that insured could be yourself, obviously. It can be a spouse or a partner. It could be your children. It could be your parents, right? You could be someone that purchases life insurance on your own parents. It could be a business partner, someone who you're in business with that you guys have some insurable interest on each other. And I want to talk about insurable interest for a moment because it's one of those things where you need to think outside of the box. And I'm going to give you an example. So Curtis and I, right, he works Practical Wealth, I'm here, we're partners in this venture. Technically, I can prove an insurable interest that Curtis and I may have on each other because we do business together, right? And I could very well say to Curtis, I really feel like, you know, my business benefits from your business, and I would like to take a policy using you as the insured, okay? And all that means is that you're carving out a component of that person's death benefit in order for you to be able to use it to create a second banking system. Because at the end of the day, the most important player in the policy is the owner of the policy. And normally most people insure themselves, they own it, right? But the ownership can be put together in many different ways. And I want to go through the list. So you can have a spouse be an owner, yourself, obviously. And what I mean by that is, so your husband and wife, and you know, the wife owns her policy, the husband owns his policy, and it's possible that the husband buys a second policy on the wife that then he owns. Same insured, two different ownerships, two different policies. So as you're thinking about how you grow your banking systems, these are the players that you have to move around to accommodate in order to be able to get different kind of policies. Your children, if you have kids, 2, 3, 4, 5 kids, those people, those lives can be insured, and you can own those policies, and you can use those policies as as your banking systems. A business, right? You can have a business where you are doing a buy-sell agreement, or you're doing some kind of business continuation plan, and you can have a business own a policy on you that's separate from your own death benefit. So a business carries a different kind of death benefit because it's really based on the value of your business. So because a lot of times we are capped by the formula 20 times income, 25 times income, which is what it's allowed normally per states of the amount of death benefit that you're allowed to have. So if you're someone that makes $100,000 a year and it's 25% what the formula is, you can only get up to $2.5 million of death benefit. What happens when you cap that? If you have a business, right? If you have older parents, if you have children that you can insure their lives, that's how you keep expanding the business. I want to talk about the last one, a trust. If you have a family trust and that trust needs to be funded in order to have some kind of legacy, some kind of estate, progression, you can have a trust own a life insurance policy in you, and it's valued as what is your estate value as opposed to an individual. Sometimes we get clients who their income may be at this level, but their net worth is at a different level. Meaning if you have a client, right, that is makes 100,000, but their net worth is 5 million, there's more room there because we can use the worth of the estate in order to be able to get a little bit more of the death benefit. All right. The next player is going to be the payer. This can also be a different person. So you pay for your own, you can pay for your spouse, you can pay for your children, you can pay for your business partners, your spouse can pay, you can have the children pay for the parents. The business can pay the premiums of your policies as opposed to you personally. And a lot of business partners do this, right? They'll buy policies on each other, and they will each individually either pay the policy or have the business pay the policy and have the owner be each. So I would own a policy on Curtis, and Curtis would own a policy on me. However, our relationship, if we had a business together, we could have both premiums come out of that business. And then the most important part of the equation is, how do you decide on beneficiaries when you start doing this multitude of policies? So a beneficiary really is based on what's the need for that policy? What is the need? And by the way, I want to talk about, this is a life insurance discussion more than anything, because remember that whoever your beneficiaries are, your banking systems, your generational wealth continuation will be based on who that money goes to after you've gone to, to meet your maker. So when you think about beneficiary, you want to make sure that you have each and every one of your banking systems with a plan as to who's going to own it, who's going to pay it, who's going to be the beneficiary and why, and have the organization to understand how those life insurance dollars will be passed down to the next generation. And I will give you a very quick example. I have a client, 3 partners that have a construction company. They're just finishing a buy-sell agreement. Each of them are married, except that now one's getting a divorce. Okay, so there has to be a policy. We have policies where the spouses are the beneficiary, right? The business goes to the spouse to buy the spouse out, but now we have a divorce happening. Now we have to change the player of that policy. So you continue to adjust. And by the way, any of these are changeable except for the insured. The insured you can never change, that's the life. But you can always change ownership. You can always change the payer of a policy. You can always change the beneficiary. But the only person that can make that change is not the insured, is the owner of a policy. So when you think about creating a multi-policy banking system because your cash flow needs it, remember that you are the owner of all of these other systems, regardless of who the insured is, regardless who the payer is, and regardless who the beneficiaries. The more policies you own, the more systems you have to control and that you're able to fund. Okay, and I want to stop here for just 1 second. If there's any questions, or does that make sense? And I hope that, and by the way, this is part of the design process, right? That we as advisors do to make sure that we're understanding what the purpose of each and every one of the banking systems. Any questions at all? Okay, I'm going to go to the next one. I'm going to start showing you how we're going to build up this banking system 1, this banking system 2, right? And how you create that multitude of policies. And by the way, we have clients that have 2 banking policies, or we have clients that have 10. We have the owner of our firm is in his, I think he's got almost 40 policies altogether, but he has a multitude of business owners. He owns a policy on me as a business partner policy that he's the Alpha Mega Wealth is the beneficiary of. Alpha Mega Wealth is the owner, and Alpha Mega Wealth pays for it. But that doesn't affect my own death benefit that I can get as an individual. And I think that that's something that a lot of people, although I may qualify for X amount, because Alpha Omega is buying it for a business profession, that's a whole different death benefit aside from my own individual death benefit. And that's important to understand, okay? So when we talk about banking systems 1 and 2, normally we begin with the husband and the wife, where the husband and the wife are the owner, the payer, and the beneficiary are the spouse, children, or a trust. And I'm going to tell you that whether you're an advisor or you're a client here, right? The need for a family trust when you own a multitude of banking systems is essential. The need to have an entity where you can have money flow through, right? If anything were to happen to you without having to go through a probate to a state, it's a planning tool that is necessary really in order to be able to move that wealth to the next generation. So if you have not thought about, and people say, well, I really don't have that many assets to have a trust. It doesn't matter. You can create a trust and then you can add assets as you go along, right? But they need to create that entity. That is the best beneficiary designation that you can have in any individual policy. I will tell you that if you're a client who has your children as your beneficiary, and these children are under the age of 18, that is the worst beneficiary designation that you can have, right? Because anyone under 18, if they receive any life insurance proceeds, they'll have to stay in the state until the child turns 18. And then you would have to hire an attorney to be able to go to the state and say, I need money for this child's education, right? You're going to have to, and that's expensive. And not only that, but gives no control to anyone. So if you have any policies at all that you're thinking about, and you think, who am I going to, I only have my kids, create the entity, create the trust. Curtis, do you agree with that?
Yeah, I do. When should they think about doing that? Like
creating a trust?
Yes.
As far as I'm concerned, I don't see any reason why anyone should create a trust as soon as you start earning an income. Because if you purchase a home, that house needs to be, and let me tell you from an estate planning standpoint, and a lot of times we don't think about what happens when we die. What is the beneficiaries left for? And I'm going to give you an example of what I'm going through right now. I have a lady, we've had a multitude of clients pass away, unfortunately, the last year. And I've been doing a lot of different claims, and I've had clients that had a trust, and I've had clients that did not have a trust. And I want you to know that the ones that did not have a trust are in probate hell. Because what happens is that you have to open probate through the state, and it's very expensive. You have to hire an attorney. You have to make sure you don't automatically get a house on an individual just because they're their kid. If there is no trust and that house is titled under that individual, that house has to go into a probate process through the courts, and the courts will then give some executor, right? Some state appointed executor, whoever happens to be of the children. And that takes a good 3 to 5 months, by the way. So in the meantime, those assets are frozen. There's no access to a checking account. There's no access to anything that you own individually. So for example, for me personally, my checking account is under my trust. It's titled under my trust. My house is titled under my trust. All of my life insurance policies beneficiaries are my trust. My car is owned by the trust. The title of my car has the trust name, not my name. Okay, because even as simple as a car that is paid off, even if, and there's small estates below 25,000. I mean, the process gets a little bit easier if it's a smaller estate. But if you have created assets that have value, $400,000 house, perhaps a $50,000 car, and those assets have to pass down, they have to go through probate. So to answer your question, right? It's about $1,500 to set up a trust. Whether or not you have children now or later, whether or not, all of our lives what we work for is to create assets, right?
Right.
So the answer that I always give to my clients is, you want to start that trust as soon as you can. Whether you make $20,000 a year or $1 million, you're still going to, especially the young ones, for example, like you, Tyler, right? You're just building, you have your business, you're creating this real estate venture. At some point, your income is going to start to take off. Your assets are going to start to go. And if you don't have a properly and, put together trust, it's going to be a mess. And what happens is, once you create the trust, every time that you gather an asset, all you got to do is just change the ownership to the trust. Now, I will say this. Every time that you want to change something from that asset, for example, if I wanted to refinance my house, I would have to get a document to take the policy, my house out of the trust, put it on my individual name, do my refinance, and then put it back inside of the trust. So there is a little bit of it's a kind of a pain in the butt. But I'll tell you this, and I've had clients who've done that and forgot to put it back in the trust, and then they died. And now their $1 million house is in probate because they forgot to put it back inside of the trust. So we always work with trust attorneys, and we always advise for you to think about this as a business, these banking systems of yours, and to really not just worry about funding, but worry about, because at the end of the day, you guys, any of us at any age, this could be our last day, right? We all think that's never going to happen to us, but it could. And, I have an 11-year-old son, for example. So what would happen if my 11-year-old inherited $3 million or whatever, right? He'll stay, the state would hold on to that money until he turns 18. And then they would hand him the money. The full, can you imagine an 18-year-old with $3 million in their pocket? It'd be gone. That money would be gone in like 2 seconds, right? The trust allows you to make provisions on how that money gets distributed, when, how much. It allows you to be able to go into further generations, grandkids, if you wanted to extend the wealth to be, multi-generational. So really think about how valuable.
I have to talk that up. I always say, I have a 9-year-old, and I heard somewhere, I say, I need to set up a trust to protect because I have 3 daughters from their future first husband.
My God. Right.
Right. So that, I don't want some knucklehead to have half my money, so if it's in a trust, it's not part of marital estate, and so y'all can use it, but if you separate, you don't get any of my money. You came in with what you build together, but you don't get my money. So,
but it goes even more than that. Even your own kids. I have, unless you're actually giving financial education to your own kids, right? It's a discussion of, when the money comes into their hands, are they prepared to handle whatever amount it is? Because they'll get it in a lump sum, right? So these are the kind of things, as you're putting.
I'm giving it. Are they receiving it? Is the question. Exactly. So no, it's going in a trust.
Well, and then inside of that trust, that's when you make, and I'll give you an example. For example, for my own trust, I have it so they receive X amount at 25, X amount at 35, X amount at 45, and then the remainder is get distributed when they turn age 50. And in the meantime, I have speculations for emergency, purchase of a home, purchase of a vehicle, education for my grandchildren. Like, there are ways that they can access more money, but they will get an income at age 25, 35, 45. Furthermore, I have it down to the point of, before they can even touch $1 of that, any of that money, they have to find a charity and give 10% of whatever they get to that charity first, because you have to give to receive. Right? If they don't give 10% of that money to the charity, they don't get a dime. Right? And that's just my own personal feeling. My point being here is that you as a person have the control of putting together the vision of how your wealth that you've worked so hard for all these years, and especially as you're building these banking systems, right? And we're only talking about banking system 1 and 2. We're going to get all the way down to like 8 or 9. That adds up to be a lot of money. How is that multi-generational wealth going to be handled? And how do you control that even though you're not here? And you control that via trust. Okay.
That's a separate, we got, that's a whole meeting in of itself. So,
yeah, that's
yeah,
the next
yeah.
session. Maybe we should just really talk about, you know,
Yeah.
the different kinds of trust, and we can invite an attorney in, because really I'm not here to give you any kind of legal advice. I'm not an attorney. I'm not telling you what kind of trust. All that I'm telling you is that that entity that you create, that is outside, protects you from a lot of, just not taxation, because that's another thing, right? Now, this two kids that the mother died, whose house is out of the trust. It's a $750,000 house. So now the house is going to sit there in probate before they can even sell it, right? It has to stay in probate until the courts decide who the executor, before they can even think about getting the money. And by the way, that's really the only money. She didn't have a lot more other than this house. But they have now all the expenses of these attorneys and the probate courts. And by the way, the loss of being able to do what? To invest that money, right? Of getting that money up front. So for another discussion. So best thing for beneficiary trust, worst thing would be children.
Right.
Just saying. And honestly, and with that being said, right? You also think about when you have someone, and Tyler, I'm not mentioning you by any means, but be careful when you say a fiance or a girlfriend or a friend, right? Make sure that those people understand that they are the beneficiaries and they have a copy of the policy and they're informed as to, because that's another thing. There's a lot of lost property out there of these kind of policies that are never claimed. Never claimed because people didn't know that they were made the beneficiaries. So we can create these systems very effectively, but we just have to really understand how and which players play what role. Okay.
Right.
So here's banking system 1 and 2. And now we're going to go to system 3 and 4. So this is when you have kids and you're able to put some life insurance on your children. By the way, your children qualify for 50% of whatever your death benefit is. So let's say that I own $1 million house, $1 million policy, and I have 4 kids. Each of those kids can get a $500,000 policy, right? So those are other systems that I can begin as my cash flow grows, and as I have more money than what my first banking policy can hold, I am creating a banking system on each and every one of those children. They're the insured, right? My wife and I, even the trust could be the insured of this owner, the owner. The husband, the wife would be the payer. And then the beneficiary are always the parents, by the way. When you use your children's lives to create banking system, the only beneficiary that it can be is a parent. You can't have a trust be the beneficiary, has to be a parent until they're age 18. At age 18, you have an option. You can either hang on to your banking system. And I can't tell you how many times I've had clients who put systems on their kids. And when they are looking for money, they feel it's like, oh, I feel guilty taking money for the kids. That ain't for the kids. The cash value is your money. The kids will get the death benefit, right? You're only using their life unless you have earmarked that specific policy for college funding, let's say. That's fine. But I had a client who had 5 different policies, 2, husband, wife, and 3 kids, and he wanted to purchase a real estate property, and he's taking out loans from the husband and the wife. And when he had the consultation to see, what made sense, I pointed out that he had another $50,000 in cash value between the 3 kids' policies. He's like, well, I feel bad touching it. No, you own the system. Right? It's part of your overall banking. So every cash value and every policy is for you to use to accumulate more wealth and more assets. So at the end of the day, if you need to wipe all of the cash values off to be able to purchase what you got to purchase, that's what you do. But here's the thing, right? What do I always say? Tyler, for every loan, there has to be some repayment. You just have to make sure that your cash flow, your additional cash flow, is replenishing those policies so that you can have them for future use. Any questions at all about children's policies?
No, it's great. Yeah,
Something to think about, right?
Yeah.
So here comes banking systems.
As long as you have the money. I just had a client. He called me and said, Curtis, he had a son, and I said, well, you can insure him, day 15 of life. But I said, would you have a social yet? No, I need a social. So he texted me this week. I got the social security number. So now we're going to, start probably his 5th or 6th policy.
Yeah, and a child can be insured, like you said, at 15 years of age, all the way up to, and by the way, you can insure
15
your children.
days. 15 days.
By the way, you can insure your children when they're even older, when they're adults, right? As long as you're the owner, you can tell, hey, I need a policy, I'm going to use your life, I'm going to own, pay, and then say, and when you retire, you can take ownership. Or when you turn 18, because at 18, you have the option of say, okay, I'm going to gift you this banking system. You can give that child and say, I'm going to change ownership to you. Now you can own it, or you can pay it, or I'm going to keep paying it and now you own it, right? Because you have the control of changing the players as the owner. So the management of the kids' policies is also something that you can kind of, and I'll use my own daughter, for example. So I own a policy on my daughter, Ali, who's 19, and now she's bought her own banking policy that she's the insured, she's the payer, she's the owner, right? I'm the beneficiary. My policies, she's the payer, I'm the payer, I'm the owner, she's the insured, but the beneficiary is who? My trust, instead of me. Do you see the difference there? So as you're putting this, spend time talking to your advisor about what makes sense. How do I set these players up so that I maximize the buckets to put as much money as I can, and I can own as many of these policies as I can. So let's look at banking systems 5 and 6. This is a business owned policy. So for all of you that are self-employed, have business partners, I have even had people create an LLC that may not necessarily hold any assets other than perhaps, I don't know, some rental properties or whatever, and try, and use those businesses to purchase life insurance for future business use. But the insured would be either the business owner, the partners, or any key employee. You can be someone who has 5 employees that are so essential to your business that there's insurable interest in these particular employees. So you can get 5 different policies with their insurer, which, by the way, you're not affecting their death benefit, right? Individually, they can go and get whatever policies they want. You are simply using their life to create a key employee where the business is the owner, the business is the payer, and the beneficiary 99% of the time is a business and or a partner if you're having some kind of a buy-sell agreement. And we can certainly have a class also down the road, Curtis, on business-owned life insurance. And what are those, what's a key man? What's a, for all your business owner clients, it's important for them to know what is a buy-sell agreement, what's a key man policy, right? What is a deferred compensation? Perhaps you have an employee that's making so much money that perhaps through the policy, you can create a banking system for deferred comp for a retirement plan for that employee. And by the way, that's a lot better than a 401k or an IRA, I can tell you that. Why? Because it's liquid. There's no taxation. So a business-owned policy has a multitude of uses, and it has a multitude of ways that it can maximize. But at the end of the day, the business is the owner, but who owns the business? You do. So you control that as well. Okay. Any questions about business-owned life insurance? Perfect. So we're going to go now to 6, 7, and 8. So here we're dealing with way outside of the box. We're talking about, okay, now I'm insured, I'm self, spouse, again, right? Business, payer, beneficiary. But now we're going to get into maybe a trust-owned policy. You have a life insurance that is literally designated to just go into the trust for future expense, such as estate tax, such as any outstanding liabilities that you may have. So basically the insurance policy is there so that when anything happens to you, whatever it is that you have, any assets that you have a large liability on will get paid off, and your heirs will continue to, get that asset without having to incur all of the taxation or even having to get rid of the asset because there was still something owed on it.
Yeah,
the
that's major. I was my wife. We did a talk to a couple weeks before last. We did a webinar, like a lunch and learn for Merck Sharp and Doane. So, my wife does estate administration, and I I didn't know this. Like she says, what people do. We're explaining it. She was explaining probate, and that what most people do is they leave everything to the beneficiaries, and even if you have a will, the money goes to the beneficiary.
Mhm.
And what you need to think about doing is leaving part of that money to the estate, because if you have a car payment, you need there's money, 'cause that's when people, these realtor, real estate investors say, well, my wife has this or my spouse has this because we got all these assets. Yes, but they're not liquid. And so you have one of the things that insurance does is gives the estate liquidity. So even though we're talking about banking, it's still insurance, and it's all of this stuff. Insurance is like a financial Swiss Army knife, right? And so, for some of the people that are on the call learning how to do this, this is, it's a big conversation. And but in the clients that are on here, this is one of the reasons that I do this, because I can get this out or send this recording out so we can have conversations, because we are, last year, I don't know what I bring in, about 100 115 new clients. I mean, the year before that about the same. So one of the things I'm trying to do with this is kind of get this out and invite conversations, because I don't know what you don't know. So it's better to do this in a group. But it's one of the things that we talk about is maximum protection, and in our process. And with the banking is one part, but also there's gaps that you don't want to have in your coverage, and having the trust, that's a big conversation. I actually didn't know all that. So in full disclosure, that's why I say I do this stuff. I learn stuff every call. I have a page of notes. All right. So
yeah, but that's what happens after 20 years, right? Of 20 years of setting these banking systems. And the thing about it is, after so many years of doing what I do, doing banking, I see it all. I see, and the thing about it is that you can only provide the information, right? The client has to own the information and really understand it. And this is why these classes are so important, because for us, we do this every day, but as a client, and you go off into your life and you get busy, and if someone doesn't continually say, hey, don't forget that you need to do this, that's what we're here for, right? To remind you, there's a better way to organize your finances, a better way to organize it, so that when something happens, you don't lose half of your assets because of debt. If you have a lot of debt, multitude of homes or a business that needs to continue to operate. There's another thing. We just had a client, the guy owned a plumbing company, and he had probably about 25 employees, and we have everything. I mean, we have these people, SEP IRS. I mean, he has policies and a lot. I mean, it's a big client of ours, but he died. And the thing is that those policies will help continue that business to run. The minute that owner dies, what happens to the business and the employees, right? These are things that we need to think about. And these are things that as your life becomes more, as you grow and as you continue, because I think that we all hope that we're going to make more, get better, continue to grow our assets. These things need to be in place. I also want to talk about a charity being a beneficiary. This is something that a lot of people don't think about, but there are a lot of people who inside of their estate want to leave some kind of like a charity, right, event. I happen to have mine through my trust, but you can purchase a policy and you can say, okay, I was approved for 2 million. I'm going to put, I don't know, 1.85, and I'm going to leave $75,000 to charity XYZ in the name of whatever. And upon that death, that charity will receive that money. So that's yet another way to kind of expand that banking system and to kind of really continue to grow. Questions? And I can go deeper, but I think that's a whole other conversation, Curtis. I think we need to have a much deeper understanding of how a trust works and why, and what's the proper way to set that up. And Erica can
I tell you, one of the things is, Eric, is, and we've had this conversation, but a lot of times, like for any of you who know pastors, a lot of times, 20% of the people give 80% of the giving, right? So that strategy now can uh, generate another money from the other 80% just by having them, if they care about the organization, just adding them as a beneficiary. And for 10,000 for our, the church I was at, we had a new sound system because the person left the church and designated specifically that out of the beneficiary of their life insurance when they passed away for this stuff. And that is, so that kind of stuff. So it's I think that's important. I think that, we have to give to the institutions that are important to us and to keep them going. And that's what, and so this allows you to do that. And it's tax-free to them.
Right. And exactly. And by the way, and again, I am not a tax expert nor a legal expert, but I want you to know that any business, right? That
I play one on TV.
Right. Any business that owns these kind of policies and takes the cash value as loans to operate, right? The interest that is being charged on those loans is a tax deduction to the business. So the premium is not, paying the premium is not a tax deduction, but any loans that come out, for example, I can be an individual that I have my first policy and I have cash and I lend it to my business. And now that business, right? That interest is going to be tax deduction to the business, and that business pays back to me the loan repayment with that interest, which I am going to allocate back to my banking and then, continue it to grow. So the way that these policies can be set up, but what I want to get through today is one simple thing. One policy is not going to get you to the banking system that you want. And normally now there is 2 or 3. So every anniversary, and sometimes it's, financially it's like, oh, well, I'm not at the point where I can get into 2 or 3. That's okay. Even if it takes you a lifetime to create those systems, but as you're generating more wealth, what happens is one of 2 things. You either spend more, but before you go and spend more, run it through a banking system first and then go spend whatever you want. Always have that in the back of your mind. Am I at a point where now I have these 3 kids and maybe I can put away $200 a month each kid, or maybe I can put in a year, they get a yearly bonus of 10,000 and I have 2 kids and that's extra cash. I'll put 5,000 and 5,000 on each. However you fund them is irrelevant. It's the understanding that you can own a multitude of them with a bunch of different players, because at the end of the day, right? What we want to create is the same model as the Bank of America. So if you recall the Bank of America, we have our earnings and the policies, right? And you see all the policies layered all up, right? As the saver, that's your segregated account right here, which is really, I should make an arrow, and I forgot to do that, to the earnings going to your family bank, then you pay the policies. But the middle, the banker, that's your segregated account. That's where all the money's coming in from your income, from your loans. That's what's moving the money between the left side and the right side, right? And then you go and do whatever it is that you want to do with it.
So let me clarify that. I think some of these people are new. Segregated account is a checking account.
Yes.
That
separate from your operating.
Separate from your, that you pay your bills with. The only thing you use it for is to manage your policy loans. Money goes from the policy into where it says the banker, because the banks, a lot of people get this confused also. The bank is not the insurance policy.
Right.
So when we say be your own banker, the bank is not the life insurance policy. The life insurance policy, think of it as the depository. That's where your cash is being held.
Your vehicle, right.
Right, it's the vehicle. So you earn it, you're making premium deposits. When you need a major capital purchase or an investment, you're going to take a policy loan, you're going to deposit it in that segregated account, and then you're going to loan it to your business or buy an investment or, get your vacation home, or some, I've used it for summer camps and $2,500 transmissions and, buying cars, right now, college,
right.
Right. And all that stuff. But I was like, all right, I have the money to pay the tuition. I'm not giving them my money. I'm going to take a loan, give them my money out of my earnings. I'm going to pay the loan back and I'm going to keep recycling that money. I do the same thing with taxes. Right. And so that's it. It's just, but you have to fund it. So, and it's things like, well, where do I get the money? Well, that's kind of the thing. It's like looking at your cash flow. Oh, well, Curtis, I just paid off the last payment on this car. Or how was the car payment? $400 a month. Well, you need to open up another policy before you absorb that money back in your budget.
Right. And that's how you build, right? You build, And sometimes what we do is, let's say that we had policy 1 and 2, now be 5 years later, and maybe I was overfunding policies 1 and 2 with, I don't know, $5,000 additional.
I'm
And I
struggling
get,
with right now.
I'm sorry, who was that?
No, I think that was me by mistake. Sorry.
Oh, okay. And what I was trying to say is that sometimes we say, okay, policies 1 and 2, right, are now cash flowing. Cash flowing meaning that the policy is growing by a greater number than the dollar that I am putting into them. So therefore, I'm going to stop funding at 5,000 each policy 1 and 2, and I'm going to take that same 5,000 and I'm going to now open policy 3, 4. And then I'll fund those for the next 5 years. And then once they get cash flowing, I'll stop taking that 5,000 and I'm going to open policies 5, 6. Do you see? So we're not professing that you're going to create this system, right, in a year or two. We're talking about a long-term building, but an awareness of every time financially that you can shift some money from here to here and you're able to flow additional cash, the best place to flow it through is banking system 3, 4, 5. And at the end, when you're retired and you have 5, 6, 7, 8, 9, 10 banking systems that each have a slew of cash value, guess what? That's your retirement fund too, right? That's a tax-free retirement bucket. And it's funny to me because, you know, I get clients that, I just talked to a client the other day and they have a 401k. And I believe that the company matches them like 3%, but they're putting 15% of their income into that 401k. After we went through this whole exercise, they're like, what am I thinking? Why would I put 15% of my income there? That's not liquid, that's taxable. Like now, I'm sorry, is that you again, Curtis? Oh, but the thing is that go ahead and put the 3% that they match you. If they're going to give you dollar for dollar, we're not going to say no to free money, right? But remember that they're really only matching you 50% because you got to pay taxes on that. And that's one of the biggest misconceptions. People say to me all the time, well, I have $150,000 in my IRA. No, you don't. You have $150,000 minus 30%. So
At
whatever
least,
that amount
right.
is, that's how much money you really have. And then they realize like, oh my God, I forgot about the taxes. So they feel confident that they're in good shape because they have 150, but what's 30% of 15? $45,000? So you really have 110, right? 105. So, you know, understanding on where you place that money and the liquidity and the tax ramifications is really what, you know, and I'm not saying it's an and or an or. You can go ahead and put money in your 401k, but if they don't match you a dollar, there really is no reason for that.
At all.
Questions? This is a good group.
Very smart.
So look at you, Curtis. Did you see?
I like that. There you go.
Did you see? I put the so my daughter's here too. Like here's my daughter. Here's Curtis and his girls, and here's my daughter, and here's my son. And this is the owner of Alpha Omega, the twin kids. Put them in here. And then the other ones are just stock pictures. But I just thought we looked really cute together. Don't we look really cute together? Anyways. Bottom line is that what will be your family legacy? And what I mean by that is the people that you see underneath you, your kids, your grandkids, right? Those are the people that are going to be carrying that banking business forward. That's your multi-generational wealth. Those policies will someday pay a death benefit to somebody, and they have to have the knowledge, and they have to have, and probably by the time that something happens, Ali's going to have a multitude of banking systems where she will take that death benefit and create more banking systems for her children. That's generational wealth. And this is my presentation. I've said it all. Any questions, comments, any thoughts? Vicky, any thoughts? You're in the business with us.
Boom, drop the mic.
Is there anything that you want to add or that I forgot to say?
Nope, I think you've covered it all. I think it's just really, you know, how we bank. That's really what it is. It's just really a different set of banking engine that we use. I mean, technically we just finance everything. So why not capture the finance interest rate? Mm-hmm. So it's just really a strategy. You know, we are using a whole life for this. However, the whole process is really a banking style. That's it. We are just changing the way we bank with Bank of America or Wells Fargo. Instead, I'm doing it under Bank of Vicky Vanilla. And, you know, it's one of those like, how many banking systems do you have? And as you continue to build and create, you're also looking at long-term. You know, people constantly look at it as short-term, but in reality, we should be looking at long-term. How do we capture back on the interest instead of trying to just really maneuver and try to make as much money. Instead, we are just showing our clients really the engine function of banking.
Exactly.
That's really it is.
And I
no
want
other
to,
thing to add it.
and I want to add to that, by the way, right? Every single bank, Bank of America, US Bank, Chase, all of them, by the way, they own billions of dollars worth of whole life cash value, life insurance on their key employees, because they understand that when you get a car loan, where do you think the car loan money is coming from? They're flowing it through those systems, right? Those policies, and you're getting a loan from the money that I deposit. So if I deposit money, they're taking my money and loaning it to Curtis. I'm making interest on Curtis, but it's my money, right? So all we're saying is make money on your own money. Don't let that banking system use your money to loan to other people.
I mean, really what we're really teaching our clients is really, it's the same thing as us going to advisor and having them manage our fund. We can technically do it ourselves. And, we manage our own fund, and it's the same thing. Why are we giving the banks money when we can just use our own money to just buy a car, to do our financing and everything else? And so it's the same thing. I finance everything that I do. And it's the same thing as like borrowing from Peter to pay Paul, and Vicky Danlot still gets the benefit of it. And so that's really what we're teaching our client is, we're really teaching you how to borrow. That's really what it is. There's a trick to it. I mean, America is based on the foundation of borrowing. I mean, even our greatest finance leader, Robert Kiyosaki, he bought his first house on a credit card. All these people have bought houses on credit. And so we are teaching our clients to also purchasing on finances and capture it back. You need money to make money. That's really the key word to it.
I want to make, there's a comment from Eric asking what's the max pays on a child. And I know, Curtis, you answered 50% of what the parent is the max, but really that's not the max. The max is $2 million. If your parents make $20 million, a child cannot get a $10 million policy.
Okay.
It's up to $2 million. So I have a client who, I'm sorry, I have this hair here. I have a client who his net worth is well over $15 million, and he himself is insured for about 12 million, but each of his kids have a $2 million policy because that's the maximum that a child. Now, once that child becomes 18, right? If you're buying policies on your older children, then that's a whole different formula. And we can talk about that. But as long as you're using children, right? From newborn to age 18, it can only go up to $2 million.
Is it like 50% or $2 million, whatever's greater, that type of thing?
Correct. You're exactly correct. So exactly. So if I have $5 million of life insurance, they only qualify for 2 million, right? If I have $1 million, they qualify for 500. So you're exactly correct, Eric. The cool thing about it though is that when you have a child that has a life insurance policy on them when they're little, and then they turn 18, and you keep those policies, right? I'm keeping my policies on my kids. I don't care how old you are, right? I didn't buy this for you. I bought this for me. That's my cash in there. That's my retirement. That's my college refund from what I'm paying for your college, right? But they have the ability to create their own systems that they're the insured, they're the payers, and they're the owners. And I can be the owner, right, of their life. So that your child could have a multitude of policies that you own. Perhaps, a spouse owns on them, a business, they own on themselves. So, there's a lot of different options.
One of the things I'm looking at the intro to becoming your own banker. So if y'all don't have that, this is our textbook. But in the intro on page 3, he says it's not a procedure to get rich quickly. On the contrary, it requires long-term planning. And so, Nelson Nash was educated as a forester. So he already thinks in like 100-year time blocks. And so he says it'll take about 20, 25 years to fully free yourself from the bank. Is this something like that, Vicky? Whereas you got it. So, but at one point, Nelson had 47 policies. And I remember him saying he hadn't used a commercial bank other than a checking account. And he passed away year before last, but in about 25 years. Mm-hmm. And he had been doing this. Like the book came out after he'd already retired, and he just wrote about what he had been doing. It wasn't some theory.
Right. And I'll tell you this, I knew Nelson Nash personally, right? I mean, I spent a lot of time with him, and he spent a lot of times with us and our family. So Joe and I know him as a friend and as a person. And he was always very candid to say that the reason he wrote the infinite banking concept, and the reason why he found this out and then started researching this Austrian economics, really is the model, was because he could not get under himself ever. He could not find a way on how to get out of this debt. He couldn't find a way to get to the next level of wealth, no matter what he did. He made more money, and yet he wasn't even getting in a better situation until he started researching and discovered Austrian economics. And then he said, gee, my life goal now, and he always said this to me, and he took, when I first met Nash, Ali was at 1 year old. And I remember him saying to me, and he said, you got to put a banking system on this little girl now. Why haven't you bought a policy on her yet? That was always his question. Why haven't you bought a policy on her yet? I was like, I don't know. It's like, well, you got to get it. But it's a lifestyle, really. It's a lifestyle change on how you manage that cash flow. So, but all that I'm saying is that he knew he missed a lot of his life in being able to do that. But his life goal was not just to educate the big ones, but he wanted the children's to learn and start their lives. Like that's why I'm excited for my client Tyler, who's on the call, that just banged his toe. Sorry, Tyler. But here's a young man who 20, 30 years from now, he'll be in a dramatically different situation than most, 50 years old or whatever, because he understands and he's doing it at age 23, 24, as opposed to at age 54. Right. So it's also time that the sooner you get started, the less dollars you're going to have to do to grow. The later you wait is the cost of waiting, right? The more money you're going to have to be able to do those banking systems. So that's called the cost of waiting. I've said
Well,
it all.
this was great. I mean, anybody have any final questions? I made this live like this because I wanted to be interactive. For our clients. So if you have any questions before we sign off, you can ask away.
Ask away.
Yeah, my main question isn't really, I don't know if you can answer it now, but I do think in general, going over trusts more in detail, but just because I don't really understand them, I guess, because it seems like a topic that I don't really understand. So I think potentially going over that, like a different, like maybe an entire topic of a webinar, I think that's something I would really benefit from.
Do you think Erica would join us maybe next month and she can do a mini class on, because I wish that somebody would have given me a class when I was young, like you, Cameron, and like you, Tyler, right? I didn't learn about, actually, it wasn't until I started these banking systems 20 years ago, I was in my 30s, when someone was just like, oh my God, you have to have a trust. Now you have kids, like now you have creating wealth, right? So I think it's an important topic, and hopefully Erica can be our guest speaker, Curtis.
Okay, we're gonna work on it.
You tell her that I nominated her for our next.
I'll do that. We'll do that. We'll do that. I think, yeah, I might recall you so we can talk about it. And then, but I think it's a good idea. I think we have to get deeper into, into personal finance. And, one of the things you got to do, guys, you got to read a book a month on money. One of the things that I told Nelson this, I said, Nelson, you created a monster, because I started working my way through the bibliography and it completely changed me, of reading Creature from Jack. It's like once you're infinite banking, it's like, I tell people, I was on some podcast, I said, look, I'm Morpheus. I'm giving people the red pill. And then if you go through that book and you read, you need the law, and you read economics in one lesson, and you read Creature from Jekyll Island and the Confessions of an Economic Hitman, you're done. You don't trust nobody.
Are you talking about the Matrix? Are you making a Matrix reference?
I am making a Matrix reference,
Yeah.
And even though he talks about Rich Dad Poor Dad. I mean, once I read Rich Dad Poor Dad, I was Neo. I at the end of the book, it was like Neo seeing the Matrix, because all of a sudden I could see financial statements everywhere, right? I could just see them. So when I talk to people, I literally see their money moving through their personal economy, through the income, expense, asset, liabilities, and I'll just draw it out, and it helps me think about, all right, here we got to pay yourself first. We're going to put it in the bank, and here's what we need to use the bank to buy back your debt and bring this money back, and I think about it, because I think in pictures, so I'm always drawing stuff out. And I think that we've got some of our, budding practitioners on here and clients, but you have to pay attention to your money. You have to count your money. You have to, do your books. You have to this is, I would say, you could call this become your your own money manager, right? Because you've got to learn, to Vicky's point, you have to manage the money. I was showing somebody illustration. People always want to see illustration. It ain't about the damn illustration. You know, that's irrelevant.
It's the behavior of the payer, right? And I will say this, right? And there's a million advisors out there that they profess that they're infinite banking specialists, whatever. And you know, the norm of every agent is I sell you this policy and I'm done with you, so I don't need to see you again, you know, probably never, right? In our model, you got to be talking to your advisor at least quarterly. Right, you got to be, if you're actively using your banking and you're actively, there's got to be communication, there's got to be understanding of which loans you want to start repaying, or you got to defer, or maybe you had a change in your business model, whatever. But the communication as an advisors, we have to do a better job in saying, hey, we need to talk, hey, to stay on top of our clients, to continue this kind of education. And that's why we've made this commitment of having these banking 202 classes, because we felt like our clients were putting their systems together. But then when it came to the management in year 2 and 3, it was like they were going back into their old ways. It's like a child who, you know, you let go for a little bit and then they start doing something bad again. And then we got to bring it back in. So the more communication, and I tell Tyler this all the time, I don't care if my clients have to ask me 1,000 questions every day. I don't care if I have to say the same thing over and over every day until they kind of, you know, own it and become. So, you know, being active on that education process and using your advisors as your coach is really the most important part of the equation.
Absolutely. So guys, listen.
5:15. Yep, I'm done.
Yep. Thank you guys for joining us. I think this is an awesome call. And so this will go, I'll send the recording out to the people that were on the call once it renders. And listen to it, get your notepad out. You know, there's a lot of stuff packed up in here. And, you know, you have to, because, you know, Jennifer, is becoming your own banker. So you got to know how this works yourself, right? And so that's why we're doing this. And we're the guides, but at the end of the day, it's your money.
Yeah.
And that's critical, you know. And that's the thing. I told you, I want to empower you to be empowered. Like, and you know, like we believe in education, because I always tell people, look, I want you to understand how to separate facts from somebody's sales pitch. And we do this because Nelson always calls, you got to have noise canceling ear ring, because ear plugs or ear headphones, because there's so much noise out there. Oh, well, I've got, you know, we use I had a guy tell me, oh yeah, I do infinite banking like you do. I says, well, I specialize in properly structured dividend paying whole life with a mutual company. He goes, oh, I've never sold whole life. Well, you don't do infinite banking then, damn it.
Right. They think
so, they think that, you know,
right.
And I wasn't in the mood for a fight, but I'm like, you know, the word police. I'm like, no, I'm borrowing from my money. No, you're not borrowing from anything, you're borrowing against. You know, I'm always like cleaning up the language of that kind of stuff, because the words are important. And, you know, we want people to, you know, we just want people to be good at it and not fall into traps and listen to charlatans. So
we just got a little comment from Jen that says, our next appointment, I was going to discuss trust with you, Curtis. Awesome.
Okay.
That's a discussion
trust of my wife.
Yes, every single person in this call, if you've learned anything from today, is right managing policies, additional policies, but most importantly is, how do I set up those players? Do I have the right entities created so that if I were to die tomorrow, my banking system does not collapse? That's the bottom line.
Right. And you're really lucky to have Curtis and Yvonne as your advisors.
Yes, you do. You know, right, Vicky? And Vicky too. Like, hello.
Right.
Right.
Awesome. Thanks, you guys. Have a great evening.
Thank you.
All right. Thank you. All right. Take care. Bye-bye.
Thank you.
Thank you.